It's Brian Preston, the money guy.
So we were talking about money as a tool. Let's talk about another tool that I think is done horribly wrong. It's used very badly. And this is number 2 on how high income people can still not be successful and do well. And that's number 2, which is debt causes a death by 1,000 paper cuts.
Yeah, this one is kind of surprising when you think about it on the surface. Generally, when you think about folks that are have debt, folks that run up, negative balances, you're like, oh, it's people who can't afford something or they don't have enough income. They're having to subsidize. I was actually shocked when we looked at some of these statistics around the types of debt that high-paid Americans carry.
Well, I think, look, this is one of those things where it builds over time. I mean, if you wonder, how does this even happen? I think this starts at a young age in the fact that you come out of school, you have some student loan debt. And you're like, well, even though I have this student loan debt,
I can do the payment.
I'm going to do a credit card or something so that I can at least go ahead and get some trappings of showing that I've got this college degree, I've got my first job. I'm kind of owed to show that have reached some level of success. Sure. I can't drive around in that beater of a car that I had. I need to get a new car. And then you're like, well, I mean, yeah, that apartment, I could get a roommate or that apartment there, but you know what would be better if I got this apartment? Yes, it's a stretch, but it's okay because I've got some debt. I've got some things. I'm going to create a bridge for myself, but I'll pay myself back in the future. And I think these are the falsities that we tell ourselves, and then we wake up 10 years in the future and we go,
how did I get here?
How did I get here? And also the opportunity cost of every dollar that you threw into that sinkhole of bad decisions is money that didn't get to go work for you as well. So we have some stats. Don't take our word for this. This is pretty shocking because we found that 17% of high income earners, this is people who make over $100,000 or more, can come up with $400 for an emergency.
Now, here's what I find remarkable, right? $400, if you think about the deductible for most insurance plans, whether it's a health insurance or auto insurance or homeowners insurance, most of them are going to be above $400.
Yeah.
What this tells me that 17% of folks that make over $100,000 aren't making it past step 1 of the financial order of operations. Yep. They can't even get the basics covered. There's no excuse for that. And I don't mean to be insensitive here, but if you have that kind of income, there is no excuse for you to not be able to come up with $400.
Well, it gets worse because you had asked me in the content meeting, because this ties into this. We found that 58% of people who make over $100,000 actually have credit card debt that's at least, meaning it's greater than $2,500. And you asked me in the content meeting, Brian, is it even appropriate for somebody? I mean, it's one thing to have credit card debt in general. We are totally against that. You can use credit cards, but if you ever have credit card debt, you've got to reevaluate what's going on in your life. What makes it even worse is if you have a good income, or the shovel that Bo was talking about. How do you have good income and then still have credit card debt?
Yeah, what I find so frustrating about this is because I like to think in most aspects I try to be compassionate. I want to understand what someone else might be going through. I'm thinking, okay, well, maybe someone had a medical bill and they had to put it on the credit card, or maybe they lost their job, or fill in the blank of all the things. But then I started thinking, no, the reason that we carry an emergency fund, the reason that we have emergency reserves is so that we don't have to find ourselves in that situation. So it has to be, really, really dire. If you have an appropriate emergency fund and you burn through all of that and you're not able to change lifestyle and you're still racking up credit card debt, I think it's borderline egregious that 58% of folks that make over $100,000 are carrying a credit card balance forward.
Well, remember, we've done shows on this, the 3 basic ingredients or components to wealth creation is, first of all, you got to have discipline.
Yep.
You got to have discipline. If you can't live on less than you make, you got a big problem. I mean, your plan is blown up before you even left the starting gates. The second component is money. That's basically where you have discipline to the point that you do have the deferred gratification to save a little bit, and then you give it time to grow with your army of dollars. All 3 of these stats, because the third one we're going to pull up is 18% of people who make over $100,000 live paycheck to paycheck.
What that suggests to me is a complete lack of discipline, right? So, all right, there's the folks that can't come up for the emergency, the $400. There's the folks that are faking it, and they have the $2,500. But then there's these folks that just say, you know what? I am going to eat, drink, and be merry. I'm going to be here for now. I'm going to just go hand to mouth, paycheck to paycheck. And I am just not of the opinion, especially at these higher income levels, that that's necessary. And so the question becomes, all right, well, how does that happen? How does someone who makes that much money live paycheck to paycheck? You already sort of alluded to it, Brian. It is, in fact, lifestyle creep. It's the decisions that they make that somehow, magically, earlier in life, they're able to live off of $30,000, $40,000, $50,000, and it was paycheck to paycheck. But now they double that income, and it's still paycheck to paycheck. Something would have had to have changed in that equation.
We didn't end up putting it in the show, but there's a scene in the movie Margin Call where they're up on the roof and they talk about how do you spend 7 figures a year. And guys, this is what I think is so unfortunate about people who are fortunate to have high incomes, but then it doesn't pan out to actually creating wealth, is that they're not only screwing up the little stuff, we'll talk about that, but they're also making the big, messing up the big life decisions. And when I'm talking about the big stuff, we're talking about housing. You know, there's a reason we give you guys the guidance of 25% of your gross income is because we want you to be life rich, not house rich, life poor. That just doesn't work. Cars. I mean, I've already kind of laid out previously that it's not uncommon for a young person to come out of school. The first thing they want to reward themselves to show their friends and family that hey, this was all, y'all believed in me and I didn't disappoint you. Mom, I made it. Look at my car.
Yep.
I mean, that's why we do set up these rules like 23-8. We want you to put down 20% down because look, we're one of the few financial pundits that actually give you the grace to actually use debt to buy a used or new vehicle. But we try to give you some guardrails because we know sometimes you just need dependable transportation to get to work and be successful. So 20% down, make sure you don't finance for more than 3 years, and don't let the payments exceed 8% of your gross income. And there's 2 other caveats. If it's a luxury brand, you got to pay same as cash, 12 months.
That's
and
it.
then also make sure your monthly investments are greater than your monthly car payment. If you've blown that part up, you need to go back to step 1, reevaluate what you're doing, because this whole thing is designed to make sure you're not living a bigger lifestyle than your wallet or your paycheck can actually afford.
So then, not only do we allow our own pride to surface when we upgrade the house or we upgrade the car, but then we allow outside social influences to affect us as well. Perhaps, Susie and John down the street send their kids to private school, so we got to send our kids to private school. We got to pay for that additional education. We want to live in that neighborhood in town, so we got to go to the neighborhood that has the expensive fees. We need that country club membership. And all of a sudden, you blink and your life has just expanded to where these big purchases have stacked up to be this insurmountable thing that you cannot overcome. And that's the exact thing that makes you go paycheck to paycheck to paycheck to paycheck.
And we've done so much incremental decision making, meaning that you take the same dollar and it's just where does it go? Does it get spent or does it actually get turned into a positive and actually get used for your army of dollar bills? And these are the things that do blow it up. It's these big life decisions. Now look, I get a little annoyed with financial media and the fact that you hear about latte effects and they hear all these things. And I'm all about, look, Bo's even got, right before we did the show, the crew went out and got him a Starbucks. I don't normally think it's the little things that derail you. I think it really is like the housing, the cars, those big life decisions. But in some ways, I think going back to those 3 components of wealth creation, discipline, deferred gratification is that first component of discipline. You do need to kind of make sure that you are, I'm not worried if you have a coffee. I'm not worried if you like to eat out every month, but it's just, you have to have this mentality that you're watching what you spend.
That's right.
So that you can build the right muscle memory with your wallet to actually have the margin to build success and wealth for the future. So, because what we see is that this is a death by 1,000 paper cuts.
Yeah, we looked at some average monthly spending on what we would call like sort of non-essentials. And so on average, and this is from Bureau of Labor Statistics, Americans spend about $300 a month eating out, right? They spend about $100 a month on electronics if you were to sort of average that out. They spend about $150 a month or a little more on apparel and clothing. And then subscriptions, they spend about $240 a month. Well, if you add all of that up, you're talking about a decent chunk that could be going to savings, a decent chunk that could be going into your army of dollar bills. Now, don't mishear us. We're not saying that you should not go out to eat. We're not saying that you should not have electronics or you shouldn't have subscriptions. What we are saying is that if you're not paying yourself first, if you're not building that muscle memory, exactly like what you said, and you're not hitting those 20 to 25% savings number, perhaps you're not at the stage, even if you have a healthy income, where you can have the luxury of doing these other things. And that's sort of a painful pill to swallow, but that's the fact of the matter. If you can pay yourself first, if you can set it up early on, you give yourself freedom to go take part in this. But if you're doing this first and trying to save what's left over, and every month there's nothing left over, you got to change it because you are not setting yourself up for long-term success.
What I find interesting is that I talk about this concept of the hedonic treadmill and how human nature is we adapt so quickly to both good and bad things. You know, you lose your job, you become disabled. You know, it's amazing how fast you will be back to the level of happiness you were before the horrible things that happened to you, just because that's human condition and human nature to adapt. The same thing happens on the positive side, is that as you do more positive things, like if you drive a nicer car, if you get a bigger house, it will give you an instant rush for a period of time. Yep. But then fast forward a few months in the future,
it just feels normal.
It feels just like what you're doing. And what I see with a lot of these things, I think it's like most things in life, sin and other things. A lot of it is actually rooted in some good stuff. I mean, eating out, you get to be with friends and family.
Go break bread. I love it.
I mean, it is building memories, good stuff. Electronics. This is something that's hopefully making your life easier. Yep. Apparel. You want to look good, you know, so, but all these things get kind of run to a degree that it becomes unhealthy. Yep. And I think that's the biggest part, to where we take it for granted. We don't even get enjoyment because it's happening so frequently. And then here's the thing, and look, I want to be confessional about this. When I saw that subscription's $237 a month, I'm like, what? I mean, this is because we did this for an engineer group, and I told Daniel, I was like, Daniel, that stat doesn't seem
can't
like,
be right.
So, but then I did a little self-reflection. And I was thinking about myself because I'm so proud. I even did a video. If you guys go look in the archives, I've got a video with YouTube TV. I was so proud because I was paying. I cut the cord. I was paying $110 a month for my satellite provider, and then my internet was like $60 a month. So I was, I'm out of pocket $160 with the old one.
Yep.
Well, then I go and hire YouTube TV for $35. And I think I had Netflix at the time, which was like $11 or $12.
Sure.
And that was it. So if you added up Netflix, and if you added up my YouTube TV at $35, and then my internet of $60, I was like, I just trimmed like $30 to $50 a month.
That's big savings,
off of this thing. Now I want you to fast forward. I don't know how we got here, but I am that 237 because think of what we've done, guys. And we've got YouTube TV. We now have look. I've had CBS All Access because they had a Star Trek series on there that when I was in Mexico one time on vacation, it was free on Netflix. It was included. It knew my IP address was in Mexico, so I could download. Well, I got halfway through a season, flew back to the States, and then it was like, you can't get this because you're back in America. And I realized that you could only get that now if you subscribe. They had some weird deal with CBS that you had to subscribe through CBS All Access.
You just described exactly what happens, right? You rationalize, oh, well, I just need this for this one thing. I just need this one for this one. Oh, well, there's this one show that my friend told me I have to watch. Well, there's this one thing that I don't want to miss. And all of the sudden, you have Apple TV and Hulu and HBO Max and Spotify and Prime Video and Disney Plus. And you look at this and you're like, what have I
And by the way, they're mean. Our rulers of subscriptions are mean dictators because YouTube TV started off at $35 a month. I think that thing might be $70, $80 a month now. I mean, no kidding. So much so that I don't have YouTube TV anymore. I switched over to Hulu, and I have Hulu Live because it was like $6 cheaper a month. Now I think it's even more expensive too. I mean, I turn into Jerry Seinfeld and my voice goes higher and higher and higher because I really do. When I look at all these subscriptions, I'm like, they got us. They got us. I went from my $110 a month that I thought was ridiculous, and now I look at all this stuff and I'm like, oh man, they did it to us.
I don't want to go off a sidebar, but I started thinking to myself, it'd be genius if a company came along and said, you know what, rather than all these individual subscriptions, what if I gave you one service, and with that one service, you had access to stuff on Apple TV and Disney and Hulu and HBO? And I basically just reinvented cable.
I did. You know what you just did? You're doing what every young person does. Now, I don't do it because I am a rule follower, teetotal rule follower. I pay for all this junk. But most of you guys, you just go borrow your friend's subscription. It's like, what's your user ID and password? And everybody's like, all right, here it is. I mean, Daniel, didn't you say you had a few seats on some of your stuff? It's just... don't say it out loud. They'll come look for you.
Here's sort of the big point that we're trying to make is that these little small decisions can add up. And if you make these little small decisions, before you make the decisions to pay yourself first, to get your army of dollar bills working, you're going to wake up one day and say, oh my goodness, how do I have $300? I saved $30 a month, and now I'm spending $300 a month, and I never actually put money in my Roth IRA. Don't find yourself in that position just because you have a high income and just because you can afford more things and add the subscription and do the extra thing doesn't mean that you should.
Well, it goes back, and I know a few of you have written, you said, if he says it one more time, I'm poking my ears out. I don't even know if that's a thing, but I had the high school economics teacher told me $100 a month would make me a millionaire.
Yep.
And it woke me up. It was like the music started playing. And it really is. We talk about 88 times over is how powerful every dollar is, especially for young people. And that's what I worry about is all these things we're talking about, these incremental decisions where that dollar, instead of going to build, went to consume, is lost. It's gone. It's sad. That's why we do things like this koozie where this $1 beer cost me $88 is because I want people to have that mindset that every dollar that you manage, be a good field general and make sure it doesn't get wasted. Make sure it actually is building something. Don't be a miser. That's why we cut it off 25%. Once you're saving 25% for the future, go have a good time. But at least make sure you're putting foundational stuff so you can actually start building wealth.